What a way to start with one of the most annoying questions that I know is asked of bankers on Wall Street. The tax savings, where did the money go? Last year, full year, $18 billion, top 6 banks on Wall Street. That's what they saved because of the tax cut. Let's talk about it, Brian. Where did it go?
Well, first of all, the reason why we saved taxes, we actually paid taxes. And therefore, we still, every quarter, are paying the 18, 19% rate plus the state taxes and stuff in there. So, you know, but what did we do with the savings? Well, we made, for the last 3 years, beginning in 17 when it passed, 18 and 19, we've done a bonus program for all our teammates, 95% of teammates, $1,000 in cash, on top of all other compensation you get for people up to one level, and above that, shares of stock equal about 6% of their compensation for 3 years in a row.
We could that deal.
Maybe we should get Brian to be our agent.
I like it.
Carry on,
we use the savings to invest in our teammates in terms of health care. We have the teammates who make less than the company. We started about 8 or 9 years ago. The people under 50,000 at that time, 8 or 9 years ago, have not had an increase in their premiums for the last 8 years. The people above that have lesser increases than what they call core rates of inflation and healthcare. We also invested in physical plant. We've built hundreds of new branches. We've remodeled thousands of branches over the last 3 years. We deployed all new ATMs effectively over the last 3 years. But then, people say, what do you do with the money? We do $1.7 billion in capital every year. Then we announced we're going to do an extra $500 million in technology. And so, well, that provides products and services and capabilities for the company. It also provides jobs because that is all coding. So it's all engineers coding it, whether they work for us or we buy from third parties. Right. So it's all good stuff.
Nothing gets near the, was it $30.9 billion of capital returns to shareholders announced last year, approved last year? Does anything get anywhere near that number?
I think the reality is it has nothing to do with the tax thing. That has to do with the fact we had more capital and we're earning $28 billion. And so between dividends and capital, we earn a lot of money and we're giving it back to shareholders. But the question is, what would you do with it if you kept it? It would just pile up. We grew loans faster in the industry. We grew deposits faster in the industry. We have enough capital to serve our core clients. In the last few years, we've overtaken, become the biggest small business lender again in the United States. We're 5% of the mortgage market, 12% of the retail market, 13%. So you add that all together, we're serving the clients well. So the capital ought to go back to who owns it.
I don't want to sit here and come across as someone who's against buybacks. I'm certainly not employed to have a position, but for what it's worth, it's not mine. What I'm trying to understand and reconcile is the stakeholder capitalism that has dominated the conversation here, the end of shareholder primacy, and reconciling that with the cold, hard numbers I see on Wall Street every year. Help us do that.
Let's back up. So at the end of the day, 50 years ago, Klaus started with stakeholder capitalism in response to the business of businesses business, which was the Milton Friedman paper in that year. He wrote a book. A couple of years later, he puts out the Davos manifesto. Then 50 years later, you've been seeing these companies, and by the way, all the other participants coming here and talking about how they solve problems. And the power of Davos is convening. And so when it heights the financial crisis, a chance for the regulators and the bankers to talk about how to fix this thing. And at different times, different things. So about 2 years ago, 3 years ago, the 140 companies signed a statement that said the companies ought to help drive progress on the SDGs. So the simple point is companies have to deliver great returns for their shareholders, a great experience for their customers, and a great experience for their team at the same time, and deliver for society. That's stakeholder capitalism. And so Klaus has been after it for a long time. The BRT statement is just really is a statement that was made that codified what we really did. And so I think if you look across the returns, we've delivered great returns for our shareholders. We've delivered a lot of capital return, but we've also delivered a lot at the same time for charity, volunteer work, investment in local communities, hiring 10,000 veterans. These are all things that are enabled by the capitalistic system.
I want to look back, Brian, and look forward. In the last 12 months, of course, all the stocks have done well. The banks have really picked it up nicely. I think people have forgotten in history the debris you picked up when you took over responsibilities for the Bank of America. What did you learn 07, 08, 09, and even into 10 that you're using now as best practices at Bank of America so history doesn't repeat itself?
Well, I became CEO in 10, so the team had to get together and do two things at once. Keep driving the core business implementation at the same time, continuing to clean up the issues around mortgage and credit card debt and whatever it was. So what we learned, and we actually have a lessons learned, believe it or not. Our Chief Risk Officer, Jeff Greener, is a superb Chief Risk Officer. He goes out and talks individually in small groups with lessons learned. It's all about over-leverage. It's about overextending at the wrong time. It's about reaching the wrong parts of credit segment. It's about over-leveraging companies. And so we try to learn from those lessons. But the main one is balance. Going into the crisis, we were way overweight consumer and way overweight unsecured consumer credit. And a lot of people talk about the mortgage, but we actually charged off $50 billion in credit card debt. And so that's when our credit card doesn't grow quite the same as other people. We are actually keeping that balance relative to the size of the whole. $90 billion credit card business, top 2 or 3 in the country, but driven to maintain excellent credit quality.
Bring the lessons learned forward now to how you're going to deploy for the new technology. I spoke to you in this valley 5, 6, 7 years ago, and you and a few others, including Mr. Diamond, were way out front on the impact of technology within our financial system. What's the lesson learned forward for the deployment of capital with technology?
Well, 3 things. One is you got to spend enough to maintain a lead on the competition, and that requires operational efficiency. It allows us to do that with flat expenses and declining expenses. And that's been the hard work the team's done. $3 billion a year in pure code. This isn't to run the system. This is pure new initiatives. So you have to be able to spend a lot. You have to have good ideas, and you have to, but the key lesson is don't get ahead of the customers and be patient that the customers will come along. So if I were here 5 years ago, we did not have, or 7 years ago, we did not have mobile check deposit. It's now 25% of all the checks that are deposited. You couldn't get ahead of the customers and try to force them to do it. You have to let it happen, and it's now passed. More checks are deposited by mobile phone for the last maybe 4 or 5 quarters than are deposited at teller lines today at our company. And so that's...
check is a piece of paper, John.
I'm familiar with it.
I don't know.
I see them much more in the United States than I do back in the UK.
Our customers wrote 700 million of them last year, so that's not a small number, just the consumer customers. So it's a big deal. But the idea on technology, invest heavily, keep the trust. That's a cybersecurity expenditure, which over that time period probably went from a couple $100 million to almost $900 million this year. And on top of that, drive your competitive advantage.
Let's get some hard numbers on the consumer business. I believe it was an interview with the FT. You said the following: a market share in consumer, 12, 13, 14%, depending on who counts. The reality is you could double that. Right. Do you want to double that? And when?
We want to drive it forward. The context that was, are you too big and do you have to go outside the United States to do something? And the answer is no, we don't. There's such opportunity in the United States because even though our market share is high, in the top 30 markets in the U.S., we're the top market share in retail banking in 12 of them. The nearest, I think, is 6 next to us. But the reality is, up until 2 years ago, we weren't in 7 of them. So if we just fill out those 7 to be like the other markets, that's a lot of growth, and we can do that all over the U.S.
You could double this organically.
The context is we have gone from probably 10 to 15% across the last few years, and so you can think of this as a challenge to my team and consumer. Get with it. Let's double it. But the reality is it's a response to how much opportunity there is in the United States left for Bank of America.
For years, you've talked about responsible growth. Let's talk about the leveraged loan business. Almost every week, there's a new shop with concerns about leverage loans. You've got great insight into this area of the market. Walk us through what you're seeing at the moment.
Well, in the end of the day, going back to Tom's point, over-leverage is over-leverage and over-leverage. And when the economy slows down, those companies are most exposed. That's banking 101. The reality is our on-balance sheet exposure in those things is measured carefully. It's very low, very low. The real question for the economy and what through different groups they're talking about is a lot of it's in funds and other types of support. And what will happen when those companies don't fare well? Will those funds work with them the way the banks would work with them in terms of working them out as opposed to just closing them up? The other question is, in a net asset value context, i.e. their liability structure moves down with the assets, that feels good at the moment. But when you trade it from that person at 60 cents on the dollar, next person, what's the next person do with it? And those kinds of questions are open. And what will be the impact on economy? Our actual leveraged lending is a very small part of our on-balance sheet credit exposure.
Everybody wants to dive into this. Everybody wants to get into wealth management. Of course, you with the Merrill Lynch platform and all that. But right now what I see is everybody out there wants to be a banker. Goldman Sachs wants to set up banking. How do you respond to whether it's in the internet technology or it's more traditional investment houses that want to get into the bigger platform? Your scale and scope, do they understand the scale you need to succeed at this?
Well, I think that you need the scale to be good, and that's what we keep talking about. Is we don't need our scale, we need our scale to actually do a great job for our consumers and our companies and And so that scale allows us to keep investing at a rate, and I think will make us extremely leaders in competition as far as we can see. When other people want to get into business, they see profits, they see profit margins, they see things, and I can understand it. But it's not as easy as they think to operate 66 million consumers who are doing millions and millions of transactions. We have $3 billion of payments that go through on the consumer side in a year. 3 trillion, excuse me. 3 trillion. To keep that all straight and make sure it all happens, gets into your account.
That's almost 1.5 apples.
That's not bad, is it?
Yeah.
And so it runs through there. And by the way, this Erica, which has 10 million users now, that's somebody talking to a artificial intelligence voice recognition machine that will translate your request and get it done. And it's 100 systems it might touch to your one account out of your 10 accounts, finding that one transaction. These are remarkable things we're investing in. That's why we've got to keep investing in technology.
Market share. We just keep seeing the US players take market share from Europe. It's a story that Tom and I talk about almost on a weekly basis now. What is it that gives you guys such a great position to take market share away from some of the European players?
Well, in the pure markets business, which is what you're referring to, because we don't operate consumer outside the United States or wealth management even, but in the pure sense of markets, what you have in our company is a great fixed income platform and a great equities platform by the heritage of the two companies. Bank of America was a big fixed income house, Merrill coming together 10 years ago. Tom Montag's done a great job of running it. But we really have a scale to offset the day's ups and downs. So last quarter, everybody was euphoric. Go back a year before, everybody was pessimistic. But the reality is that business earns $600, $700 million to $1 billion a quarter for us. Wealth management earns $1 billion. Commercial banking earns a couple billion plus. Retail earns 3 or 4. So we have the stability, and that's what makes us competitive. Is we can extract the value of that business across all these other businesses. The research platform works with wealth management. Candace Browning Platt, #1 research platform here, going into wealth management. That scale allows us to be competitive, and I think, and we can balance it off. Right. It's only a third of our balance sheet. Other people, it's 90% that are in the business. That's a trickier execution.
I'm going to rip up the script here as we near the end of this conversation. And I want to talk about not so much the past, but the branding and marketing forward. The Hong Kong and Shanghai Banking Corporation has an image of branding that goes back to the 19th century. Bank of America, and certainly a modern Bank of America that you were given a responsibility for, in the minds of people is San Francisco, the Carolinas, Boston, 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 and the rest, piecing it together. How are you going to brand forward the image of the Bank of all of America?
Well, the Bank of America has also been operating since the first bank to operate in Japan. 70 years in China, I think 60 or 70 in Mexico, 100 years in Argentina probably or something like that. So it's been operating all over the world. And so the idea is Bank of America stands for excellent service for clients, institutional clients and retail clients. It stands for, we want it to stand for stability and knowledge and intelligence, and we'll be with you and stick with you through thick or thin. And that's what we've been after. And so the brand that we have is a strong brand, and our customer scores the highest on all businesses, and it's a great company, and I have the honor of running it for a while.
Brian, got to wrap things up by talking about...
There's some news there for a while.
A while in the context of a 230-year history, it's just a while.
A while, a year, a while, 5 years? Is there something? Is there something there we can go to here?
Everybody asks me that. It's like they want to get rid of me. I'm happy doing this job, and as long as the board will have me, I'm good.
But if the Red Sox want you to manage, you'll take it, right?
There was one thing that I'm probably not competent to do for sure, and that's be a Red Sox manager.
That would be the rest of us.
Brian, final word on the politics.
He's getting signs from over here.
I'm sure he is. Yeah. Going into election season, is Wall Street going to become a political football again?
Look, we serve society. Society is the voting populace. It's always going to be in that, and it hasn't changed for years. And when people ask me about the things going on, they say, how about those elections? How tough is it going to be? I said, well, the one in 1800 was pretty tough. We were there then, and we're there now. So it's part of doing what we all do, which is run companies that society depends on to help fuel the economy. Therefore, we have regulation. Therefore, we can get caught in the discussion. But that's part of life.